What is a credit score and should you even care about it? What are the benefits of having a great credit score and what can you do to get the highest score possible? Hello everyone, welcome to my channel. My name is Vlad. I'm a realtor and a real estate investor here in Metro Detroit. Today we will talk about the importance of having a great credit score and how to build a highest score possible. Before we begin, I would like to remind you to hit the like button, subscribe, and leave me a comment on topics you'd like me to discuss in the future. This really helps out the channel and means a lot to me. Your credit score is a numerical representation of your credit worthiness, and it's used by lenders to determine the likelihood of you repaying a loan on time. It is literally used everywhere where the money are involved. You want to rent an apartment? The landlord will want to look at your score. You want to buy a house or a car? Same thing again. The lender will want to see your credit score. You want to open a credit card or maybe even finance a phone purchase? You guessed it, you will need to have an established credit score. One place where I'm sure you didn't think credit score matters, but it has actually a big effect, is car insurance. Car insurance companies use credit score to come up with how much you will need to pay for your car insurance. There are a lot of debates on if insurance companies should be using credit score to calculate your payment or not, but that's not what we're talking about here today. Credit scores range from 300 to 850, with a higher score indicating better credit and a lower score indicating a greater risk of defaulting on a loan. If you have a score of 700 or higher, you're considered to have good credit, but if your score is below 600, you may have trouble obtaining a loan or a credit card and could be charged higher interest rates. How is this score calculated, you might ask? Well, nobody can really tell you for sure, as the exact formula is kept confidential, but we have at least some information on how credit bureaus calculate your score. The most widely used credit score formula in US is called FICO, and it consists of 5 key factors. These factors include your payment history, credit utilization, length of credit history, credit mix, and new credit applications. Payment history is the most important factor in determining your score, accounting for 35% of your total score. This factor looks at your history of making payments on time, including whether you have missed payments or have a history of defaulting on debts. Late payments, collections, and bankruptcies have a negative impact on your payment history, while a long history of on-time payments can help improve it. So as long as you make your payments on time, you should be good to go with this part of the formula. Credit utilization accounts for 30% of your credit score and measures the amount of debt you have compared to the available credit. It is generally recommended to keep your credit utilization below 30% in order to maintain a good credit score. For example, if you have a credit card with a limit of $10,000, you should aim to keep your balance below $3,000. Once again, the absolute best thing for your credit score is not to carry a balance at all. But if you do have to keep some balance on your credit cards, make sure you're not using more than 30% of your available credit. High credit utilization is seen as a sign of financial stress, as it indicates that you're relying heavily on credit to make ends meet. Length of credit history accounts for 15% of your credit score and measures the length of time you have had credit, including the age of your oldest account and the average age of all of your accounts. A long credit history can be beneficial as it demonstrates your ability to manage credit over an extended period of time. On the other hand, a short credit history may indicate that you are a new borrower and therefore a higher risk to lenders. This is why it's super important to keep your older credit cards open, even if you're not using them anymore. Credit mix accounts for 10% of your credit score and measures a variety of credit types you have, including credit cards, loans, and mortgages. A diverse mix of credit types is viewed favorably by credit bureaus, as it indicates that you are capable of managing different types of credit responsibly. New credit applications account for the final 10% of your credit score and measure recent credit applications and credit inquiries, as well as how often you have applied for credit. Applying for too much credit in a short period of time can be seen as a sign of financial stress, as it indicates that you're seeking more credit than you need. So the more you apply for credit, the lower your score will become. So to review, these are the several factors that can cause your credit score to go down, which includes making late payments, having high amounts of debt, applying for too many loans or credit cards at once, and having a history of bankruptcies or foreclosures. If your current score is low, you just need to work backwards on the list I just spoke about. The things you need to do to increase your score is continue making payments on time, keep paying down your debt, and keeping your credit card balances low. Additionally, establishing a credit history by using credit cards or taking out small loans and paying them back on time. This can help increase your score over time as well. If you had some missed or late payments before that are showing up on your credit report, you can write a goodwill letter to your creditor or lender explaining why you were late and what steps did you take to ensure this will not happen again in the future. Sometimes the creditor or lender will remove those past late payments on your credit report. If you have no success with removing your late payments from your credit report, you just need to continue making on-time payments, and your late payments will eventually just fall off your credit report. Another way to increase your credit score is to become an authorized user on someone else's credit card. This means that the cardholder adds you to their account as an authorized user, allowing you to use the card and build your own credit history. Usually this is done by and for the people that have great trust for each other. I just don't see someone letting a complete stranger to become an authorized user on their credit card. When you become an authorized user on someone else's credit card, the credit card company will report the account activity to credit bureaus. This includes positive information such as on-time payments and low credit utilization, which can help you establish or improve your credit score. However, it is important to understand that as an authorized user, you are not responsible for making payments on the credit card. This responsibility lies solely with the primary cardholder. If the primary cardholder misses payments or exceeds the credit limit, the negative information will also be reported to the credit bureaus and may have a negative impact on your credit score. In order to maximize the benefits of becoming an authorized user on a credit card, it's important to choose a primary cardholder with a strong credit history and responsible financial habits. This will ensure that the credit card activity reported to the credit bureaus is positive and will help you establish or improve your own credit history. Another super important point is that you need to monitor your credit report regularly to ensure that the information being reported is accurate and that you are benefiting from the credit card activity as an authorized user. If you notice any errors or negative information, you can dispute it with the credit bureaus and work to have it corrected. If you don't have a credit score yet, there are a few things you can do to establish one. One of the easiest ways is to get a credit card and use it responsibly, paying the balance in full each month. Another option is to take out a small loan and make payments on time. If you are having trouble qualifying for a credit card or a small loan, it is a good idea to get a secured credit card. Unlike traditional credit cards, a secured credit card requires a cash deposit to be used as collateral in the event of a default. This deposit helps to reduce the risk for the issuer, making it easier for those with limited or no credit history to get approved. When using this secured credit card, all of the same rules apply that I just talked about, so make sure to be responsible. Essentially, go to your local bank, ask them if they have secured credit cards, ask them if they report activity from these secured credit cards to major credit bureaus, and if they do, apply for it. Use this card and you will see your score grow. So there you have it. Your credit score is an important factor in determining your financial stability and ability to repay loans. The difference between having a low score and a high score can cost you tens of thousands of dollars. A person with a low score will get a car loan, for example, with 20% interest, while somebody with great credit can get that same car loan with 3, 4, or 5%. This same concept applies to all other types of credit. Understanding what impacts your credit score and taking steps to improve it can help you secure better loan terms and lower interest rates in the future. I hope this video has provided you with valuable information on what a credit score is, what it consists of, and how you can build it. Remember, if you need help buying or selling a home in Metro Detroit, you can find my contact information down in the description below. Please leave a comment on other topics you would like me to discuss, subscribe, hit that like button. Thank you for watching and see you later.